Imagine waking up one morning to find the global economy on fire, banks shutting down, jobs disappearing, your savings gone. This wasn't some freak accident. It was a time bomb built by greed, denial, and the illusion of easy money. Everyone thought the system was unbreakable until the floor vanished beneath it. Let's rewind to where it all began. September 2008. A bank with 158 years of history simply disappears overnight. Lehman Brothers, gone. $600 billion vanish into thin air. Retirements wiped out. Jobs evaporate. And the world stops, stunned. But this tragic collapse didn't show up unannounced. It began years earlier, with a promise as bold as it was simple. Why rent when you can own? That billboard line was the siren song of the early 2000s in America. The dream engine whirs. The dot-com bubble had burst. The Twin Towers had fallen. The economy was battered and anxious. In response, the Federal Reserve slammed interest rates towards zero. Money became cheap, borrowing nearly free. All of a sudden, buying homes wasn't just an option. It felt like the only move, because when money is cheap, miracles seem possible. Homes weren't just shelters anymore. They were trophies. They were status. They were the path to the American dream. And for the banks, they saw gold. They saw opportunity. Ready for $500,000? The banker asked. We only make $40,000 a year, you say. Not a problem, came the reply. Adjustable rate, balloon payment, ninja loan. Ninja? No income, no job, no assets, no problem. Because the message was everywhere. Rent is for losers. Own your home. Secure your future. And so millions bought into the dream. Even those who could barely scrape together $5 in savings, because lenders started handing out subprime loans, risky mortgages to borrowers with shaky credit or no credit at all. And all this was okay, because the market only went one direction. Up. Home values were climbing by the week. Your neighbor's house doubled in value in months. It was normal. It felt unstoppable. The gold rush in full relent. Families were swarming into houses. Brokers were hustling like it was a game show. Down payments? Optional. Verifications? Optional. If you had a pulse, you got a mortgage. It looked like a boom. It was a boom. Everyone was winning. At least, that's what the numbers looked like. But behind the scenes, a monster was being built. Banks knew. They knew many of these loans were shaky, yet they didn't stop. Instead, they got creative. They took thousands of these risky mortgages, bundled them together, dressed them up in investment-grade suits, and sold them off as something entirely different. Mortgage-backed securities. Bad debt turned into safe investments. And to sweeten the deal, credit rating agencies stamped them with the top letter grades, AAA. Why? Because the banks were their clients. It was like paying a referee to call a match you control. And now came the next act. The greatest trick. Wall Street didn't stop with bundles. They invented the next layer. CDOS, collateralized debt obligations. Deeper, more complex, more lucrative. It was financial alchemy. Take a pile of junk mortgages, mix in some clever structuring, wrap it up. Sell the top layers as senior, safe tranches. The rest, hidden risk. On paper, brilliant. In practice, ticking time bombs. Then a few skeptics saw it. They read the fine print. They smelled the bait. They asked, what if we bet against housing? Wall Street chuckled. Then they built it. The banks created insurance-style products, credit default swaps. You don't even have to own the underlying mortgage bundle to bet it fails. It's like buying life insurance on someone else's grandmother and rooting for her to slip on the stairs tomorrow. Suddenly, everyone had a bet. Some betting the market goes up, others betting it will crash. The party continued, and the laughter grew louder until the music stopped. The house of cards sways. By 2006, the smoke started to show. Missing payments, empty houses, some homes being purchased not to live in, but to flip. Wall Street continued dancing, but the floor beneath began cracking. Then it fell apart. Housing prices stalled, then dropped. The idea, prices never go down, shattered. Borrowers sank underwater. Homes were worth less than their mortgages. Banks held mountains of worthless assets. Investors saw that their AAA-rated securities were rotten, and in September 2008, the collapse came. Lehman Brothers filed for bankruptcy. The global financial architecture began to crumble. A world in shock. In days, credit froze. Banks stopped lending to each other. Companies couldn't make payroll. Retirements disappeared. Millions lost jobs, homes, dignity. The U.S. economy plunged. From London to Tokyo, from Reykjavik to São Paulo, the tremors spread. Stock markets dived. Banks folded like dominoes. It was the biggest economic breakdown since 1929, the Big Save. With the system on fire, the U.S. government faced a brutal choice: let everything burn or rescue the arsonists. In October 2008, they chose to rescue. They launched the Troubled Asset Relief Program, TARP, a massive $700 billion bailout. Simultaneously, the Federal Reserve fired its monetary big guns. Interest rates near zero, printing money, buying bad debt, a process called quantitative easing. Think, patching the Titanic with $100 bills. Shockingly, it worked, sort of. Markets stabilized. Banks loosened. The stock market hit bottom in March 2009 and started climbing back. Wall Street exhaled, but Main Street was still holding its breath. The real fallout. 8 million jobs gone. 4 million homes foreclosed. $19 trillion in household wealth erased. Families who played by the rules suddenly underwater, owing more than their homes were worth. Meanwhile, Wall Street executives walked off with bonuses. The same institutions that caused collapse got saved. The people who lived through it. They got pink slips and food bank lines. In 2011, in New York's Zuccotti Park, thousands gathered. Tents, drums, cardboard signs. We are the 99%. This wasn't just about bailouts anymore. It was about a system rigged in favor of the powerful. Privatized profits, socialized losses, zero accountability. No major Wall Street CEO went to jail. No handcuffs. No perp walks. Just golden parachutes and quiet retirements. A lesson we keep forgetting. The 2008 crisis changed everything. Broken lives, shattered trust, fragile systems revealed. But the lesson echoes. Bubbles always look harmless until they pop. Because before they crash, they feel safe, logical, unstoppable, and that's what makes them deadly. So next time you hear someone say, "This time is different," remember 2008. Remember the era when everyone thought they'd struck easy money, until the floor collapsed beneath them. The economy is like gravity. You can fight it for a while, but eventually it always wins. The fallout nobody wanted to see. After the dust settled, America looked around and didn't recognize itself. Neighborhoods once bursting with life were now ghost towns of foreclosure signs. Families who once mowed their lawns and hosted barbecues had vanished overnight. On some streets, every third house sat empty. Blinds drawn, grass overgrown, silence heavy. And those left behind? They were angry. They had trusted the system, the banks, the regulators, the experts. They played by the rules. They believed in the American dream. And they watched it collapse like a sandcastle in the tide. The government tried to reassure them. Officials appeared on TV, speaking in calm tones about liquidity and confidence in the system. But for the average person, those words meant nothing. What they saw were empty wallets, lost homes, and Wall Street executives collecting bonuses while they applied for unemployment. The message was clear. When the rich gamble and lose, they get rescued. When ordinary people fall, they hit concrete. Wall Street's quiet comeback. By 2010, the headlines had shifted. Banks were profitable again. Stock prices rebounded. The same institutions that nearly destroyed the global economy were now thanking taxpayers, with TV commercials and glossy ads about rebuilding trust. It was surreal. The firefighters were the same ones who lit the match. They spoke of moving forward, while millions of families were still drowning in debt. And the outrage began to simmer. People started asking questions, uncomfortable ones. How could banks sell junk as gold and walk away rich? Why were regulators asleep? Where was the accountability? Congress held hearings. Executives testified. They expressed regret, offered apologies, and walked out untouched. Not one major CEO went to jail. Not one. The system that was too big to fail proved it was also too big to punish. Main Street's reality. While the stock market soared, Main Street's recovery crawled. Unemployment lingered near double digits. Families cut back, sold their cars, postponed retirement, moved in with relatives. Graduates entered a job market that didn't want them. People stopped trusting banks, stopped trusting politicians, stopped believing the game was fair. And in many ways, they were right. Because after 2008, the American economy didn't just lose money, it lost faith. Faith that hard work leads to stability. Faith that the system rewards honesty instead of greed. Faith that someone, somewhere, was watching the store. The global shockwave. And it wasn't just America. The financial virus spread worldwide. In Iceland, the entire banking system collapsed. In Greece, government debt exploded into crisis, sparking protests, riots, and years of austerity. Europe's economies trembled. Asia's markets buckled. Trillions in global wealth evaporated. The ripple of a single spark lit in U.S. housing. The same pattern repeated. Governments bailing out banks, citizens bearing the cost. A new phrase entered the global vocabulary. Too big to fail. It meant if a corporation is large enough, powerful enough, its failure would wreck everything else. So instead of letting it fall, the system props it up. In theory, that prevents collapse. In practice, it creates immortals. Institutions that can do no wrong because they know they'll be saved. The human toll. But numbers never capture the real story. The story was a mother packing boxes at midnight because the sheriff's sale was at dawn. It was a father explaining to his kids why they couldn't stay in the only home they'd ever known. It was retirees returning to work at 70 because their savings vanished. It was young people learning that the dream they'd been sold, study hard, buy a home, build a future, could crumble overnight. And through it all, Wall Street kept climbing. Bonuses returned, record profits returned, even risk returned. Because memory fades, and greed doesn't. Occupy everything. Then came the moment that changed the conversation. September 2011, Zuccotti Park, Lower Manhattan. A few dozen people with tents and signs began chanting three words that would echo around the world. We are the 99%. It wasn't just a protest about banks anymore. It was a cry against a system built to protect the powerful and punish the powerless, against privatized profits and socialized losses, against a financial elite that played by different rules. Soon, the tents multiplied. Thousands joined. From New York to London, from Madrid to Melbourne, the message spread. The world's working majority had finally connected the dots between Wall Street's recklessness and their own struggles. Even if the movement faded, its slogan stuck: the 99% versus the 1%. A new way of seeing the world, the recovery that left people behind. The official story says the crisis ended in 2009, that the recession was over. But for millions, it never truly ended. Wages stagnated, debt ballooned, home ownership, once the heart of the American dream, became a privilege for the few. The economy recovered on paper, but not in people's lives. Wall Street partied. Main Street patched holes. The stock market soared to record highs, thanks to trillions in newly printed dollars. But that money didn't trickle down. It flooded upward. The rich got richer. The middle class got smaller. Inequality widened into a canyon. And yet, politicians celebrated the comeback. Confidence is returning, they said. But confidence in what? A market that rewards risk-taking billionaires and leaves everyone else behind. The forgotten lesson. Every financial bubble begins the same way, not with panic, but with euphoria. Because before a bubble bursts, it feels like progress. It feels like innovation. It feels like destiny. People stop asking questions because they're too busy winning, or trying to. And the louder the celebration gets, the more fragile the tower becomes. It happened with tulips in the 1600s, with tech stocks in the 1990s, and with houses in the 2000s. It will happen again, just in a different disguise, because greed has a short memory and confidence has a long leash. The seeds of the next crisis. After 2008, regulators promised reform. New rules, tougher oversight, no more wild bets. And for a while, the system behaved. But as the years passed, the pressure to innovate returned. New markets appeared, new technologies, new kinds of assets, crypto, NFTs, meme stocks, different tools, same temptation, easy money, fast profits, and the belief that this time, the old rules don't apply. The details change, but the pattern doesn't. When everyone is convinced they can't lose, that's when the next crash begins to brew. A mirror to ourselves. The 2008 crash wasn't just a failure of finance. It was a mirror showing what happens when greed outruns caution, when belief replaces logic, and when systems built on trust forget who that trust belongs to. It wasn't just about bankers or politicians or regulators. It was about us, the society that cheered as housing prices soared, that borrowed more than it could pay, that equated success with excess. We all wanted a piece of the dream, and we all paid the price when it shattered. That's the uncomfortable truth about 2008. The bubble was built by millions of tiny choices, each one rational, each one justified, all pointing toward disaster. Looking forward. Today, the world feels eerily familiar. Debt levels higher than ever, markets inflated by optimism, people chasing the next big thing. History doesn't repeat, but it rhymes, and the chorus sounds the same. This time is different, but it never is, because in every era, the same ingredients mix. Ambition, fear, greed, denial, and faith that gravity won't apply this time until it does. The real lesson of 2008. If 2008 taught us anything, it's this: the economy isn't an abstract machine, it's people and trust. And once that trust breaks, no bailout can fix it. Money can rebuild banks, but only honesty rebuilds faith. The next crisis won't come from where we expect. It never does. It will start small, rational, invisible. It will grow quietly through loopholes, optimism, and willful blindness. And by the time we notice, it'll already be too late. That's why remembering 2008 matters. Not as a history lesson, but as a warning. The final thought. The global economy is like gravity. You can fight it for a while. You can build higher, leverage harder, believe deeper. But eventually, gravity wins. Every boom meets its bust. Every fantasy meets its limit. And every generation learns, or forgets, that nothing grows forever. So the next time someone says, "It's different now," the next time easy money feels too easy, the next time the world insists the good times will never end, remember this story. Remember the families who lost their homes, the workers who lost their jobs, the dream that turned into debt. Remember the billboard that started it all, and the lie that echoed through an entire economy. Why rent when you can own? Because behind that simple promise was the most expensive lesson in modern history. And if we don't remember it, we'll pay for it again. Thanks for watching. Hit that subscribe button for more deep dives into economics, politics, and money.